Your mind is looking at something, and subconsciously you see risk. What you do is you avoid dealing with it and just telling yourself, I'm going to succeed, so I don't need to pay attention to risk. Stupid. Many companies fail because they succeed. Their growth actually kills the company. You may say, how is that possible? 3 years ago, I was competing endlessly with shops, and they were all over the place, new ones, on and on. It's just gone. They're gone. They're all gone today. The thing is, though, that was guaranteed. Failure is guaranteed. If we understand failure, if we understand how it works, we can manage it. Don't run from it. Drive into it. Build to fail, and success will follow. What's up, guys? It is crazy out there. We have a lot going on. Markets don't know which way they're going. It seems like we're headed to a recession. In fact, all year, everybody has been saying we're in a recession. A few industries are absolutely in a recession. The commercial real estate industry for the last 3 years has been struggling, and we're going to get into that. There is a lot on the horizon that it feels like could disrupt the economy. This causes stall out. This makes people freeze. It's been very difficult for our company, which we manage over 300 million in assets, to operate, to move forward, because we are in a market of buyers and sellers. And the spread has been crazy because there has been nobody that can seem to agree on value. This is continual, because this is the same across all industries, meaning that there seems to be a valuation problem. Why? Driven because of the cost of money, as well as the future outlook. But really, these are all part of a greater trend that's been going on. Now, we're not going to talk so much about macro trends. Instead, we are going to talk about how to build and how to invest, be entrepreneurial in this environment. And most people are doing it wrong. The key here is most people are building to succeed. That's right. That's what they're doing wrong. They're building to succeed. That sounds ridiculous. I know. But it is actually a fatal flaw. What I want to show you and describe today is how you need to build. And that's you need to build to fail. And if you do that, you will succeed. Now, what I mean by building to succeed is wrong. You don't start anything, you don't invest in anything unless you think it's going to succeed. So there's no reason to even why are you doing it? The degree at which it may succeed, you may look at and try to figure out. But of course, it's like contracts. You see, you make a contract, but you don't use a contract unless things go bad. So people go into partnership agreements, they have a contract, but they make a contract as if they're going to succeed because they're not thinking about failure. But the only time you need a contract is when you fail. So then when they fail, or when there's hard times or there's disagreements, the contract's useless. It doesn't even address the very things it was meant to address. It leaves them open, exposed, and it can make what may be a minor failure or disagreement into something that is catastrophic financially and on friends, relationships. It's something you want to avoid. And it was built with the wrong intent or the wrong purpose. When we build businesses, when you invest, you are looking at the upside. When we look at the downside, it is purely on what to avoid, or maybe what the total risks are, or may be, and how to not ever have that happen. But here's the thing, you cannot take out failure of the process. It doesn't work. It is integrated, integral part of the process of everything. Now, people that buy stocks or real estate, they think, well, I don't want it to fail, but in certain times it will. But it doesn't mean you're going to lose everything. Meaning this, if you buy, let's say, a real estate asset and you pay $2 million and that asset makes you $100,000. Then you go a year later, interest rates go up, and so values go down. And instead of being worth $2 million, it's worth $1.5 million. People would go, it failed. but it still may be making the exact same amount of income and you may not need to sell. So it actually doesn't matter. But the market is failing. You can't sell it. You can't get any of that equity creation out because there's not only none, you're negative. You are underwater. This is a short-term, momentary failure. That's the key. You should be investing to fail. Your investment strategy should allow you to fail at certain times in certain ways, to manage failure, not get rid of it because that's not possible. That's what we're going to talk about today, including entrepreneurship. I have built now multiple companies that do 10 plus million in revenue, well, 4, and I have 2 companies that do far, far above that. We fail at all of them all the time. My original companies that I started, when we failed, the company was over. I just didn't succeed. And that can either stop you and just give up, or you can learn from it and try again. That is a horrible way to do it. Failure shouldn't mean you give up or you stop and have to do it again. Failure means you learn something and you keep going on the same path. The difference in failure in an entrepreneurial venture of failing completely, as in what you wanted to create, the market won't accept. It doesn't exist. There's no value there, right? And it's just over. And it's over because the idea doesn't work. Like, it will not be accepted in the marketplace. Or how the vast majority of businesses fail because certain things along the way happen. A lot of people don't know that many companies fail because they succeed. That's right. Their growth actually kills the company. You may say, how is that possible? Well, it's possible for a lot of reasons. It's possible due to constraints in capital needs. It's possible in the fact that you are ordering more product, your sales cycle is taking off, and you have gaps in funding that then you can't fund, or the strain of all the growth collapses operations. You can't get products to market, and its own success actually tanks it. You have unhappy customers and you get bad feedback and products are wrong and you have all these mistakes and the company implodes. That's common. When you invest, you should be building an investment company. Now, you may say, I don't want to own a company with employees. You need to think of your investing like a business because we don't gamble. That means that one investment you should not expect to just make you. Like, you're not, oh, I bought Bitcoin and that's going to become $1 trillion and so I'm going to retire and I'm not going to do anything ever. No, that's not how investing works. Investing, you create a thesis and a process to get returns or outcomes over and over and over again. You should be treating that like a business, right? You're looking at the revenues, the asset, the capital, how much you have, redeploying it. You should be creating systems to learn and to understand market timing, what's actually generating the yield from those investments, what works, what doesn't, reiterating, treating it like a business, getting outside people to help. You need to have your team of accountants, attorneys, on and on and on. You should have an LLC that owns the LLCs that own the assets to deploy that thesis and strategy. There's a lot of things that you should be doing when investing, which is not just buying something and hoping and praying that it retires you. That's gambling. It's not what we're talking about here. So, once again, even investing, most people's thesis has no room for failure. It either works or we're screwed. This is why during hard market cycles, so many people collapse. Like I said, the commercial real estate industry has been in a recession at best. It has been bad. Now, a lot of people don't understand how bad it is, and I'm going to share why we haven't seen that, but this will change this year. 3 years ago, if we wanted to get an investor, lots of businesses, they go out, they're marketing, you're putting your name out there, on and on. It would cost thousands of dollars to acquire one investor, literally just to get one, and bring him into your investor pool, thousands. It was so expensive. Lots of times it made no sense to even try to do it on your own because the cost of everything from doing the marketing, the pay-per-clicks, on and on and on, it just was so expensive till you actually got capital. The reason was there were so many people trying to get investors. That thousands of dollars, like ridiculous amounts, has gone down to hundreds because that market has just collapsed. The competition is gone. 3 years ago, I was competing endlessly with shops, and they were all over the place, new ones, on and on. It's just gone. They're gone. They're all gone today. It is amazing over what in the last 3 years has happened, and it's been sad. The thing is, though, that was guaranteed. Failure is guaranteed. Now, I learned this going through 2008. I had the fortunate to be in a fortunate position where my father was a salesperson. He was a broker. He sold group medical insurance, and he taught me how to do that. That's what actually brought us out of poverty. My father grew up in extreme poverty, and he sold insurance. I followed in his footsteps, but we sold insurance to groups, group medical. That meant businesses. So during 2008, I had my book of business. I got paid from clients who paid me because we advised them on all their medical benefits. During that time, I spent 2-3 years where basically my job was just working with people that were going under. It was a scarring time to be starting in your career because I'd only been a few years prior to 2008. So it was within the first 5 years, right? It was year 4 or whatnot of me starting. And then I spent, all of a sudden by 2010, I'm like, half my career has been 2007, 8, 9, and 10, just people going under and going in and having meetings saying, well, I think we could reduce costs. We could do some stuff like that so we could increase the benefits and we could get you like big savings. And like, you don't understand. I'm going under. I can't pay any of this. All my employees that we cover are going to be gone. Everyone that went through that knows that was a very, very terrible time. Investments were failing. People lost everything, even though their investments were making money. How'd that happen? Well, they had a cash flowing asset that made them money. The market went down. The asset's price dropped in half. Even though it was still making money, they could pay all their bills. The bank was like, your asset's underwater. We're taking it. Even though they could pay the debt. The only thing that changed was what a buyer was willing to pay on the market, even though they weren't even for sale. After that, we had a huge cohort come in, and that was the millennials. The millennials grew up in the greatest bull market the world has ever seen, and that was fueled by government spending. Assets skyrocketed. The early millennials, not the later ones, but the earlier millennials, those that bought houses, those that invested in the stock market, they actually became the richest of any generation prior. That's right. Millennials were the richest generation ever. Not all of them. In fact, it was the opposite. It was a tale of two cities for millennials. The millennials that invested became richer than baby boomers ever had. In fact, baby boomers are the highest bankruptcy of any generation ever. Baby boomers struggled. I mean, their inflation and interest rates were double what ours was at the highest point. And they went, and not only did they go bankrupt more than any other generation, it was by a lot. They got slaughtered. Millennials came in and they had no economic downturns for the longest bull run ever. But millennials really had it rough. Why? Because they came in just after or during the financial crisis. To say scarred is an understatement. In fact, so much that millennials wouldn't even buy houses. There was a huge trend, for a lot of you that don't remember, where millennials were like, buying a home is stupid. Like it was like there's just this movement of this, where millennials, it was cultural. Don't buy houses. Our parents did that, and look at them. So they avoided it. Well, millennials all started buying houses at a very interesting time. That time, well, as they got older and millennials entered into their 30s, and particularly their mid-30s, they all wanted houses and started buying right around 2019, 2018-19. And COVID came in, and they kept buying. Housing prices skyrocketed. The biggest generation ever all started buying homes. But because of the Great Recession, we didn't have homes because we hadn't built homes in America for years. We were millions of homes short. So millennials are competing, houses pricing goes up. And then what happened? COVID, government spending, trillions and trillions of dollars created inflation. Interest rates go up. Now millennials can't own homes. So millennials have had it rough. because most of them started way too late and they started in bad environments. So they are not only not feeling rich, right now, millennials are struggling. This, though, is normal. Don't go in the comments and be like, how can you say this is normal? I'm hurting. I'm totally empathetic. I'm telling you, I understand. But it is. You're talking about generations that had gas shortages, interest rates at 16%, that had how many credit crises through the 80s, the early 90s, 2001, 2008. The economic crisis that other generations have gone through have been big. Now you may say, it's different this time. It's different every time. Now I agree, and you can go watch the other videos that talk about the macroeconomic side and why this time is actually scarier. Why? Because it's not a private sector thing, it's a government thing. It's a whole different story on that end. But the point is, they're always different and we always struggle. But for some reason, it seems like people, when they invest, start businesses, they think that this time will be different. And so they just plan on success. Now, how do you actually plan on failure? Why would you do that? First of all, because failure is an integral part of the process, by taking it out, your success is happenstance or luck. Including failure allows you to build, create, and move forward. Everything works in a bull market, you guys. Everything. The amount we have struggled in the last 3 years is insane. I fail, and I've failed a lot in my life in ways that are not just financial, anything like that. And two, not because of markets, because of stupid things that I did with my own money. Bad. Like, I got frauded. I almost lost everything. I almost went bankrupt. I almost lost my family's everything. My dad had gone out of poverty and made a life and a name for himself. And I almost lost it all. And that was simply because I signed a contract to buy a business that I was set up, and it was fraud, but it was my fault because I did it. And I had to learn a lesson. Devastating. Devastating. Almost took me down. I learned a lot of lessons. And these are the lessons between '08, between fraud almost getting wiped out, between lots of businesses, ones that have been incredibly successful and others that didn't work out, COVID. I'm a millennial. I'm not a baby boomer. And I have grown in this massive change and investing in this massive change our economy is going through. The things that we see today in the economy started in 2008. Most people don't realize that. So in this landscape, with things changing, I didn't understand. I became obsessed. I went back to school to get my MBA, and the only reason I didn't care about a degree, anything else, it didn't have anything to do with pay. I just wanted to ask questions and build investment thesis. So I just went to learn, and I built some investment thesis. Private equity firm came about it. I failed because I became fully paralyzed, haven't been able to walk. I've learned from my failures, and they are what's created where we are today, who I am today, and all the flaws. So I want to share with you the things that I've learned so you don't have to repeat them in the horrible manners that I did. What I learned that is the correct way to build is to understand failure. Everything works in a bull market. To expect there to always be a bull market is insane. Now, what to do? All right, first of all, the illusion of fail proof. That doesn't exist. So this idea, when people say, what if I fail? You should say, and how I really think through this is, you will, just make sure it doesn't kill you. So the when you guys are building out failures, the first thing is prioritize, minimize, leverage, and then learn. So I want to understand in my business where we are short. What are the things that are what I would call not deal breakers, like killers, as in this will kill my business. This will kill the deal. These are things we can't come back from. So we want to break down risks. First of all, there's risks that will end you. These are not the same things. That's number one. We understand all the things that could go wrong, and we put some into one bucket. Perfect example of this, you may put a depression, right? That is a deal killer for me. That is a game over for everyone. I can't do anything about that. So when I look at certain failures, there's just nothing we can do about it. But other failures, we can either avoid or manage. The second bucket that we would look at, these are failures that are outside, and we need to manage the impact on the inside. This is the difference between intrinsic and extrinsic. Extrinsic is market prices, okay? So if you're starting a software company 3-4 years ago, the multiple may have been like 30x, and today it's at 15x, half that valuation, right? But if you are a cash flowing business with customers, that may not matter to you. That matters if you have to sell, if you have contract disputes and you need valuations, or if you need financing or refinancing for capital bringing in or investors. That all takes into account that. These are outside forces. If you're investing in real estate, think sell of the property or a refinance where interest rates come in, they do a value, interest rates or the value of the asset take into place, and that can literally end you, even if it's cash flowing. Lock those liabilities out as long as you can, and that allows fluctuations for external things in the market. The next thing is internal failures and managing all the things that could go wrong there. It's not about running away from them, though. It is about actually encouraging them. So we want to prioritize. We want to then minimize. We want to leverage and learn. Failures can be leveraged into amazing, great things. So if I have an investment thesis that I'm going out, my first investment that I do when I know very little, I am using that. I want to minimize that. I want to prioritize, first of all, everything that I need to learn for number 2, 3, 4. I want to prioritize my learning. I want to minimize the overall impact, and I want to protect myself against what could happen. Then I want to leverage what I learn, and I want to leverage those failures, and then I learn from them and apply them. So then the next time my risk of knowledge and understanding and execution goes down, I can get a little bigger because my overall risk is less. I understand more. I can protect it more. I can do more, and so on and so forth. I've learned what works so I can maximize those returns better. This process over and over and over again. But the one failing shouldn't take me out, because then I can't do the rest. If I have a business, when you start out, right, cash flow is king. I like bootstrapping. The reason why I like bootstrapping is because if I take a bunch of investor money, I'm investing huge amounts of capital. I'm hiring people, even though I don't have anything proven or figured out. That means I'm doing the opposite. I'm not prioritizing because I'm doing so much at once. I'm not minimizing. I'm actually maximizing failures. And then I'm leveraging, but in the opposite way. And then I can't really learn. Why? Because the feedback loops are so fast when you have lots of capital and you're moving fast. Those feedback loops are having so fast and you might not even see where they're connected. Understanding when you're starting out or even starting a business, getting the fundamentals right, allocating capital, leveraging as you move forward, maximizing that learning, minimizing that upside. You're giving it a purpose. I know I'm going to fail. Where am I going to fail? Why am I going to fail? And how do I use that? Lean into it. Failure shouldn't stop you from doing things. It is a roadmap. Meaning this, that little voice in the side of your head that everybody says to ignore, right? You can't do this. You're going to fail. Don't ignore that. He is your best friend because he's logical and he is right. The problem is you tell yourself, he's not right. I'm going to succeed. What happens then is this. Your mind is looking at something and subconsciously you see risk. What you do is you avoid dealing with it and just telling yourself, I'm going to succeed, so I don't need to pay attention to risk. Stupid. Instead, this is how you take care of that. You say, okay, voice in the back of my head, you say I'm going to fail. How? Here's everything that could go wrong, right? That nervousness, that anxiety. Make a list of everything. When you have this list of everything that could go wrong, you go through, and the first ones you go, doesn't matter because I can't control it. Depression, doesn't matter because I can't control it. Now, all these other risks, they're legitimate, they're real. Walk through them. How can I understand it? What does it mean? How can I manage it? What are constraints that I need? If I don't know, call somebody and find out. Learn about it. Once I get through that risk, then I can tell my brain, you're right. And we've created a plan and we've managed it. What you're doing is you're moving forward in confidence, not insanity by telling yourself that you're just going to be successful, so fake it till you make it. You want to build a process for success. You don't want to get lucky, but you can't build a process unless you fail. I know when I start, I'm going to fail. So instead of thinking I won't, trying to convince myself and others I won't, I need to make sure it won't kill me. I need to fail small, fast forward, and I need to move. I need to be able to absorb it, and then use that as fuel to continue. So every investment starts obviously with downside protection, right? If I can't, so if I look at the worst case scenario and I can't live with it ever, then I shouldn't be doing it, first of all, right? I'm not chasing unicorns. That's not what I'm trying to do here. I'm not gambling. I'm not doing that. If you can't fail small, you will eventually fail big. I promise you that. And if you don't know how to fail, when you do, it is going to be devastating. I was a big skier. Every time we went out, I would crash. You're like, well, AJ, you weren't a good skier. Actually, me and my buddies, we saw it very differently. If you didn't crash, you weren't pushing it. You're like, well, you don't want to get hurt. Well, you see, there's a difference between just crashing and getting hurt and crashing, but you know how to crash. If you know how to crash when you're skiing, you can really minimize. It doesn't hurt. You know how to roll and tuck. You know what to do. You know what to avoid. You know where your edges are. You know, I can't crash here. I can't get, so you're managing it. Then we crashed all the time, but you get better and better and better. I know that when I go to do my first backflip, I'm probably not going to land it. I've never done it before. So I assume I'm going to crash. How do I crash then? That's how we learn. That's how we grow. But for some reason, people investing in business, they don't understand, or they don't believe that or think through it. They just think failure's game over. So then they just stop. It just ends them. That is not what we want. Now, perfect example of this is failures that I'm having recently. During this massive contraction, I've had multiple sites in funds that we bought that have just, we protected, we managed liabilities, but we had somebody build in that market, which I can't control what other people do, right? Interest rates went up, shut down. They opened up, dropped rates by 60%, just killed us, devastated two of our locations, limping along, but they're not going to kill us. They're not going to take us out, anything else. In fact, opposite, we're going to sell them, reallocate capital, and the fund will still make money. We'll still get it. It doesn't mean we're not hurt. It doesn't mean it hasn't sucked. And it doesn't mean we're not failing within it. That's different, though. Most people over the last 3 years failed, and they'll never recover from it. They didn't have a plan to fail. Interest rates went up. They had a floating rate, went up. They couldn't pay. They had to give it back to the bank. Like game over. That to me is terrifying. I'm already understand that there's so much out of my control that I can't control, that I know that I can be taken out. So I want to limit and minimize that, watch out for it, expect it, underwrite for it. I want to plan for it. So when it's occurring, I actually know. In fact, in 2021, I wrote something called the self-storage bubble. At the time, everything was great. Interest rates were low. Booming. I brought the first bear case where I outlined this is what's going to happen. We're in a bubble and it's going to pop. Now, at the time, people were like, AJ, you're in this industry. This is what you do. You're like the king of storage. You've written 2 best-selling books, on and on and on. You have this big company. You're out telling people there's going to be a self-storage bubble and you need to raise capital. I said, yeah, but wouldn't you rather be with the person that can see the danger than the person that says, don't listen to him, it doesn't exist? It didn't make me bad. It didn't make me a bad investor. It didn't make it that I didn't believe in the asset class. It didn't mean that I was against it. It just meant that I understood it. That's the difference. So you could plan around it. It didn't mean that I did not face the consequences of something like this massive downturn. I did. But what we did do is we refinanced our whole entire portfolio and we put the majority of our assets out for 10 years. So the higher interest rates didn't affect us. It meant that we brought in cash so we could survive. We didn't have to do capital calls. Instead, we came in and assets that were struggling, we covered. You can't make it so you don't have any effect of any kind of market event, especially when you're big. Of course, we had a couple of sites that struggled bad, but we had a whole portfolio of sites that were fine. They were doing great. But that's the key right there, managing it. I did that personally, where I set up different ways that I make money. I have certain types of revenue that I go after that are non-correlated and offset each other. I have equity, real assets. That's like real estate, storage, right? Things like that. Real hard. I want cash flow from it, but These are long-term investments, fundamental, good ones. The next one I have is cash flow. Now that can be earned income, or that can be things from like cash flowing businesses that are really low multiples, but they're principally cash-based businesses. The other ones that I have are scale. These are businesses that I understand are creating systems, processes, they're market tested, but they are built to scale. It's an equity play. Like it is, these are going to be big, we're going. I can counteract those. I can base income on known things that allows me to leverage up, to understand in assets without having the downside. I can actually not take income from certain things and keep income at one. Obviously, it didn't start out like that. I had one income and it was sales and I was on a treadmill. That's why I started investing, because I'm like, if something happens, we're dead. Like I can't make money. I don't know how I'm going to pay for anything. I got kids. That's why we started investing on the side. And guess what happened? I became a quadriplegic and I got fired from my job in the hospital. My income did go away, but it was cash flowing based assets that saved me. It took 15 years to get there. I'm not telling you that this is just something overnight. You have to work on building your income, investing. You have to fail. That's the point. You have to fail, but not stop. Approach failure differently. Approach it as part of the plan. Operate on first principles, not FOMO. The thing that I see today in the market is there is the best deals in so many places in the market. Is the best time to be buying. But the fear of failure is so big, people aren't. Even though 3 years ago, everybody was buying because there wasn't fear of failure. Here's the key. 3-4 years ago, nobody had any fear of failing. Nobody was even looking at it. In one industry that I'm in, I built like the first bearish case anybody ever heard and actually showed. Nobody was even looking at that. They couldn't even imagine. Even though at that time, that was the greatest point of risk in the entire cycle. Then when you're on the bottom of the cycle, you are actually at the lowest risk of failure because it's already happened. Yet that's when the fear of failure is high because of confirmation bias. Assets are becoming more. They're just going to keep becoming more. It works because I can see it. I understand it. Then they fail. Well, of course they're failing. There's a lot of risk because I can see it. I can feel it. That's confirmation bias. But it doesn't predict the future. In fact, at a certain point, it changes the odds completely. If we understand failure, if we understand how it works, we can manage it. Don't run from it. Drive into it. Build to fail, and success will follow. Build to succeed and not think about failure, and then you're just gambling. I hope that helps everybody. Failure is not fun. It sucks. I've done it a lot. It's embarrassing. When I failed because I was fraud, it was my name. It's the industry. I embarrassed my family. I embarrassed me. It was my career. Like it went on forever. It didn't end quick. It's not some story where I'm like, oh yeah, I fell down, got back up and ran. It's not how it works, everybody. Failure hurts. It hurts emotionally, physically, spiritually. I gained a lot of weight. It's not good. It went on for years. That's why you want to take asymmetrical bets on your failure. When I fail, I want to do it asymmetrically. I want to minimize those failures and I want to maximize those upsides. If you can learn to fail, you will always succeed.